Saturday, August 4th, 2018, Monaco 64, home of alternative economics and contrarian views. I want to talk about gold and silver, but especially gold, and how the central bankers have to use the price of gold to regulate their fiat money system. And what do I mean by that? Well, in a fiat money system, the money becomes always worthless. As time goes by, worth less or worthless, if you want to call it that too, as it's a system based on debt. You need to keep paying off the debt by issuing even more debt. So it's natural that it ends up that this debt becomes worth less and less against real things. Even when you look at the mechanism of financial centers, especially the City of London, compared to the real economy in the UK. The real economy, you go anywhere to buy a product, and you can see that there's a 20% value-added tax. But in the City of London, there is no value-added tax for financial transactions. So that encourages even more creation of debt, inflation. And I'm going to look at some charts because I know it's been a frustrating year so far for precious metals, especially holders of dollars or people who are domiciled in the United States. The dollar has been quite strong in the last few months. It started the year quite weak, and it's been rebounding, and that's kept the gold price coming down the last few months or so. But I want to show you first a chart of the British pound price of gold. And as I've probably told you before, some of you may know, I've been involved in precious metals personally. I started buying gold coins in 2002. And this chart here is from the LBMA, London Bullion Market Association. I'm very critical of the LBMA, but they have a good chart here of XAU GBP, and this chart is the PM fixing. I could have taken the AM fixing, but they look fairly similar. But I always remember in 2002 when I first bought my first gold coins. I didn't really know too much about gold, the relationship it had with different currencies, the dollar, and then I started learning more and more. And then in the next few years, I realized that whenever the dollar was weak, gold would go up, and vice versa against the other fiat currencies. And as you can see here, it was quite frustrating from the time I started buying just above 200 pounds. Up until like the last quarter of 2005, each line there is 3 months, just to let you know, on the horizontal axis. Look how many years it took. It took almost, since I started buying it in 2002, it took almost 4 years for gold to start moving, and it was stuck between 200 and 240 pounds for all those years. And I remember back then seeing this price action. I worked in the city, I was watching it every day, even though I still watch it every day. And I was wondering what was going to make gold go up in pounds, because every time the dollar went down, the pound price of gold did nothing. But eventually, all prices of all currencies in gold went up, as you can see there, and it started around just before the beginning of 2006, and we had quite a few big sharp corrections, like 2006. We had a big drop there, and then it corrected for about 18 months, and then just before 2008 it went up again. 2008 corrected down, and then up and down, up and down, and then we had the top, of course, in 2011. And I think that's all it is right now, is a correction. It's been a lot more pronounced, but as you can see now, lately we are near the lows, but comfortably above the, just before Brexit there, I think we're trading we touched 700 pounds an ounce, and right now we're around 935. So back to what I think is happening. Yeah, we talk a lot about reset, and I've spoken about the reset, if it's going to happen in 2018. But I actually think these central bankers, they keep resetting the system every few years. And they use the gold price to do that, because a higher gold price just means you're inflating away the debt. That's what FDR did in 1934. He had to do it officially because there was no gold was money then, and the price was fixed by decree. There was no market, like people didn't trade because it was money. So he just had to devalue it from $20.67 to 35, and he did it overnight. And one of the reasons why I think they do it every few years is that they don't want people to know that this is what they do, or else their fiat money system wouldn't work, because people would rush out of the fiat money system. They would know that that the money is always inflated away, because if they did it, you know, gradually every day of the year, every decade, right? So they have to kind of manipulate the market in order to keep the public's participation in the market, in the precious metals, as low as possible, or else their scheme doesn't work. And that's what I think we're seeing. I think we're near the end of the present correction. It's lasted about 6 years. 2011, you could argue in 2012 we were still quite elevated. So it's normal. I mean, you look at the chart from 2000, gold really took about 5, almost 6 years to really start moving. So this is not unusual. And yeah, I've been there and I've seen it. But look at the reward that you would have gotten by holding on. If you bought like I did in 2002 and got rid of it just before 2006 and never got back in, you would be like, even now you will have had regrets, I would say. And I think we're right near the point where we're going to see another move higher. And one of the reasons they need to do this as well is that they've thrown everything at the system, all the debt. And even though we're told that things are fine in the economy, low unemployment, no inflation, maybe there is an inflation in their measurements, and they're frustrated because they need inflation to wipe out the debt to keep things getting devalued. So I think it's just about time now that they do another, and they're going to benefit from it. And with that, I wanted to look at a story. I'll put a link to it below the description. It's from King World News, his latest article, and it says, bullion banks set to torch hedge funds in the gold market. What does that mean? Well, a lot of the hedge funds are massively short, but the commercials have they're at levels that we haven't seen in years. They're almost like flat gold. They could be going long, and that's a bullish signal. And the same thing for silver. We are at levels that we haven't seen in many years. And the sentiment, of course, is really bearish in the precious metals. So this is, if you haven't bought any gold and you're thinking of buying, I think there isn't a better time to buy it than now. And by buying gold and silver, I mean the physical coins or bars, and yeah, not paper gold. Mining stocks is more of a speculation, and I'm not here to advise you on that. I mean, I would do your homework before I get involved in that. So that fits in well with this sentiment, and I think we're ready to move a lot higher in gold, not only in pounds but in dollars as well. I don't know exactly when that's going to happen. It's really difficult to say. I don't think anyone can tell unless you are one of the insiders. So what else? Just show you some more charts here that makes me think that we're close to a bottom, and we're going to start moving higher. I know I've said this in the past, but as I said, it's difficult to tell the time. We just have to try to read the tea leaves. I think technical analysis is a good way to do it. Fundamental as well, and the fundamental part is that they've inundated the world with more and more debt to solve a debt problem from '08. And right now things are not really going great. So they need to let the steam off. They need to devalue the debt because there's too much debt. The people who are going to get hurt are those who hold on to that debt, be it in the bank, paper money, bonds, in my opinion. Even though bond prices might stay fairly stable, they will lose in relationship to bullion. So I've spoken in the past about the gold-silver ratio, how that's a good indicator for the overall precious metals or gold and silver, and that I think it was a couple of weeks ago, I said that it looked like we're forming a right-hand shoulder of a head and shoulder for the gold-silver ratio. And if you can see here, yeah, it looks like that right hand shoulder is evolving, and it's actually coming back down. So that's a good signal there too. A head and shoulder formation is bearish. We do need to break the neckline, which is probably going to be below 75 in that ratio. It closed at just below 79 yesterday. Longer term, you see that this 80 level is a very big resistance, especially in the last 20 years. Every time we get near that 80 level is just before gold and silver start moving higher. The last time we were there around 80, in the early 2000s was 2003, just before we started moving up in gold. And then 2008, when gold and silver corrected during the financial crisis, gold went from 1,000 to 670, and then that was a top there at 80. And more recently, we've had kind of two tops around or just above 80 in 2016, when gold bottomed just at the end of 2015. And then more recently now, it was April 2018. And what this means is that when the precious metals bottom, silver will outperform gold. And that's why that ratio will go down, because it's the price of gold divided by the price of silver. It's how many ounces of silver you need to buy an ounce of gold. In the last 40, 50 years, I think the median level for this ratio has been around 50, 52. 2011, when the precious metals had a great year, we went to almost 30. It could go towards 50, definitely, in the next year or two of this precious metals bull market, secular bull market, I would add. And I would say it started in 2000, 2001. So yeah, if you enjoyed this video, please like, share it, subscribe to my channel if you haven't yet. You can also follow me on Steemit, DTube, and on Twitter. And I'll talk to you later. Take care. Bye.